We're going live.
For real this time.
For real. For real this time. All right. Those little technical glitches, but it's all working out. Let me make sure that the Tech Sherpa live page is actually working. Make sure. Yep. All right. All right, that is working. Excellent. Okay. So this is April 1st, and we are Tech Sherpa. We're a part of Tech Sherpa anyway. And I'm your host, Neil, and this, with me is Serena. And Fatma, you're invisible on camera. Are you there?
I was going to say that. Yeah.
Cool.
Okay, so,
I'm here.
so Fatma's here but invisible.
Yes.
But this is the $1 Trillion Show. And we can talk a little bit about why I call it the $1 Trillion Show. So let me share over there. That's me. By the way, if you're in the Atlanta area and you need somebody good for headshots, doing all this kind of stuff, let me know, because I've got people. So the mission. The reason it's called the $1 Trillion Show is because the mission is to save Americans $1 trillion in taxes. Now, Elon is doing his part. He's trying to cut $1 trillion. Lutnick, who's the Secretary of Commerce now, he's trying to raise $1 trillion in golden visa, whatever tariff stuff. But I want to cut $1 trillion from the government as far as like not give it to them. That's very different than what they're trying to do. So they're trying to bring spending down and bring revenue up so that the budget can balance. I'm trying to remove the money from their hands in the first place. So it's a different approach. But obviously, we can't do that all by ourselves. And so the only way that's going to work is through technology, because technology scales, unlike our normal client services. So it's now April 1st. We have 2 more weeks until the April 15th deadline. Everybody who has their stuff in to Tax Sherpa by today, essentially, we're going to get done. Anybody who comes in after, they're going on an extension. That's just how it is. So there's a very real limit in terms of what we can do on a one-on-one client basis. But with technology, we can scale that virtually infinitely. And so there's a lot of tools that we are putting together, some that are already developed, some that are currently in development, courses and calculators and guides and books and all these sorts of things. So like the book I'm working on right now is about how the guru culture online of like hustle, wake up at 5 a.m. and grind all day, and that's not actually real life. And I have the statistics to prove it. You can look at the IRS statistics and you can see that less than 1%, it's actually far less than 1%, of tax returns have more than $1 million of earnings. And so, when people are talking about it's like, oh, I need a 7-figure business and doing this and that, it's just not reality. What is reality is that small business people who go into business for themselves, if they're successful, they're going to be around $200,000 to $300,000, and then they stop. They stop growing, and that's okay. That's the whole point of the book, is that it is okay. There are psychological reasons for that. There are economic reasons for that, and it's perfectly fine. You have a very different business between being a solo operator, making a good living, versus growing a larger operation with multiple people. You have to be a different kind of business owner, and most people don't want to do that. And the book is telling you that's just fine. Just do things your own way. And while you're there, let's take advantage of all the tax advantages that we can. So it's stuff like that we're going to deal with in terms of scaling tax savings to the masses. And if we get a few million people saving $10,000-$20,000, we'll get to $1 trillion without too much trouble. It might take a couple of years, I'll be honest, but we'll get there. So this is me. I'm the guy who used to owe the IRS $1.3 million, got nasty letters in the mail. And if you've never been through it, first you get letters, and then if you ignore those, you get certified mail. And if you ignore those, that takes like a year and a half to go through that process. If you ignore those, then you'll start getting phone calls. And if you ignore those, then they'll start taking your stuff. That's what I went through. And that started in 2007 and culminated in 2009. And then that got me into the whole tax world. So So for those of you who have had tax trouble or maybe are in tax trouble, I understand your pain. I've been there. And that's what started me on this whole crazy journey, 15 some odd years ago. And so the what's one particular piece of technology that we put together is the starter course. So you can go into the Explorers, and I'll show you how to do that later. That's very easy. And then you can get onto the starter course, which is kind of like a basic intro, sort of. It's a starter course, right, for tax planning. And it kind of guides you through whether you're a solo operator of a business or if you have a day job, how can you do some things in order to capture some tax deductions for yourself. And then couple of questions. But before we get to the questions, I did want to talk a little bit about the things going on in the news. So normally, in an average year, our business is not so news heavy. There's, like once every 10 years, there's a tax bill, like the last one was in 2017. There's one being negotiated right now, but this year has been insane. So the thing this year is that the guys at DOGE and in conjunction with the Social Security Administration, they are turning off or marking as deceased about 3 million Social Security numbers. And so these were, according to reports, these were numbers that were in the Social Security database, but had to have been at least age 120 and up. And, there's some people are somewhat doubting, depending on what political side you fall on, as to whether that's really true or not. But for whatever the case is, these were deemed as inactive for legitimate purposes. And so they're turning all these Social Security numbers off and they're marking them as deceased. And people are wondering what is that going to mean? So for people who are born in the U.S. and given a Social Security number usually when you're born or within a couple of weeks, this should have no effect whatsoever. Because I checked I checked with AI, but apparently the oldest living American is 114. So, so anybody 120 and over is not a real person, or at least not a living person. So, what could happen is that people who have used these Social Security numbers are going to have whatever benefits they were getting from that to be cut off. Could be people working under fake Social Security numbers. It could be people applying to different government programs, and then whatever program they're applying to checks the Social Security number to make sure it's a valid number, and they say yes, it is valid, but it doesn't say, hey, this is valid, but is assigned to somebody who should be 128. So they're attempting to cut down on that type of fraud. So whether that will work or not, we shall see. But that's the attempt at the moment. But for Americans who are using the Social Security number they were given at birth, shouldn't make any difference whatsoever. There was also Elizabeth Warren was in the Senate today talking about how they're trying to cut off benefits by closing offices and all this kind of stuff. And that's not really true. So the major change was that if you wanted to apply for benefits or if you wanted to change like where your monthly deposit was going, up until now, you were allowed to verify your identity over the phone, which to me sounds insane. Because anybody could get your Social Security number. Everybody's Social Security number has been hacked. You can go, if you go on the Tax Sherpa blog, there was an article I wrote probably a year ago at this point. There was a big hack, and the interesting thing about this one was that normally the people who hack Social Security numbers or bank accounts or whatever, they sell that to other malicious actors. This particular data dump was put just on the web publicly. Anybody could have downloaded it, and anybody did download it. And so there was a tool in there that you could check your Social Security number to see if it had been in this data hack. And I checked mine, and yes, it was. Now, the address that it had for me was my parents' address, which I haven't lived at since 1996. But it was an address that I had, and it was my Social Security number. So, I know my info is out there, and your info probably is too. So the fact that anybody could get on the phone and say, "Oh, I'm so and so," I'm Mr. Jones, and my social security number is 1234, whatever. And if you could change, I got a new bank. If you could change the deposit to this new bank, that would be great. Um, that's a terrible system. So, so I think that's a good change that either you have to go in person to verify your identity, or you have to use the online tool, which you have already verified your identity through the online tool. So um, I think that's fine. That doesn't mean you can't call with a question. It just means you can't call and have monetary impacts on the account. So that's the story. The news about Social Security offices being closed is kind of it's not wrong, but it's like what's the word? It is cast in a deceptive way. So there are like many rooms that have been closed, like within other buildings, but the Social Security office is still there. So um, that's it's just a weird way to frame the news, I guess. So yeah, so that's what's going on with Social Security. So everybody who's getting benefits should continue to get benefits. If you're going to apply for benefits, then you're either going to do it online or in person, and that's where we are. So yeah. Sorry, have we had any questions about Social Security specifically in the last week or two?
No, so
No?
no, no
Okay.
questions. But the news is there to scare you, right? Like
Yeah,
media is just
well,
there to put everybody in a fear kind of state of mind. So
yes, I would say that's true. If it bleeds, it leads, as they say.
a lot of
Okay.
people believe.
Yeah. Now, one other thing I wanted to share with everybody is that so the I don't know if you use Twitter the same way I do, but I'm in a lot of like business threads and tax and all this kind of stuff. And one of the things that people are doing with the latest AI tools, there was a release a week ago or so about how the image generation has gotten a lot better. And so people have been posting like fake receipts for things. And the and usually they're just jokes, like, for $1 gazillion. I saw one today. But it got me thinking, it's like, so for the malicious actors out there, it's like you could generate a pretty good looking receipt as though you had taken a picture of it and include that with your files and say, hey, I spent cash on this thing. And so let's turn it into a deduction. And the thing with cash is that the receipt is the proof, right? So if I have a picture that is indistinguishable from a real thing, then I don't know how you would actually combat that. So I gave the same prompt to both Grok and to ChatGPT. And I'll show you, Grok did not do a great job. So I said, can you make me a photorealistic image of a receipt held in my hand? The vendor should be Waffle House. The items on the receipt should be 2 drinks for $3.98, one scattered, smothered, covered for $9.78, one waffle for $10.22. I have no idea if those prices are right. I'm just making stuff up. The receipt should subtotal to $23.98, add tax of $1.68, and total out to $25.66. The receipt should then show cash paid of $30 and change issued of $4.34. So the difference between the way I write that and the way most people are the ones I've seen are that none of them have gone into that detail. But if you were trying to scam somebody or scam, your tax preparer or whatever, that's the kind of detail you would need. So you can see here that it's not great on the Grok side of things. The text is did not work out well. Uh, but a ChatGPT, that came out pretty good. The only thing it messed up on was it said change of 4434 instead of 434. And that could be easily fixed. Um, but
Wow,
everything else came out perfectly.
that is crazy.
Yeah. So
So
the
here's the
the
receipt, right? Here's the
that's a re
receipt.
that's a receipt. That could be my hand, I don't know. It's
Yeah.
so if you're trying to create fake receipts, the time is now, I guess.
Oh, so
But
funny.
don't actually do that,
Don't do
obviously.
that.
But
He's
uh,
playing.
but anytime there's a tool, people are going to abuse it.
That's
Um,
correct.
like in the IRS world, every year the IRS publishes a list of what they call the dirty dozen, which is like 12 scams and things to watch out for. And that doesn't, the dirty dozen does not mean that these things are not valid. It just means that people have abused them. So what I saw a case this past week of a conservation easement. So there was a company who that bought some land for $6,000 an acre, and then they got an appraisal supposedly for that the highest and best use of the land would have been to like mine granite or something, and therefore it was valued at like $200,000 an acre. And then they put it into a conservation easement, which creates a charitable deduction. And for $200,000 an acre, as opposed to the 6,000 that it cost them. So that got thrown out in court, basically. And that's the kind of thing that, it's a perfectly valid strategy or maneuver, but the way that particular person went about it is wrong because they abused it. And they were making up, bad numbers essentially. At least that's according to the court. Maybe there was granite mining on it. I don't know. But but the court did not agree. So, whenever you are looking at technologies, at strategies, at anything, you gotta make sure that it's internally consistent and makes sense. Okay, with that said, let's dive into the questions because I do know the answer to every tax question, and the answer to every tax
Drum
question
roll.
is it depends.
It depends.
It depends is always the answer because it depends on your facts and your circumstances, and what is true for you might not be true for other people. And my favorite example is cosmetic surgery. So there's there's all different examples of this. So let's say you let's say you get into a car accident and your face gets smashed. You get a nose job, um, and then that expense is that a medical expense. Now, normally cosmetic surgery is not a medical expense because it's elective. But if you got your face smashed in a car accident, then it's restoring your original function and therefore is a medical expense, even though the nose job is the same. Same thing. There was a famous case with an exotic dancer, and she got her boobs done, and for her, it was a business expense. It's not a business expense for anybody else because she was able to prove that it improved her income opportunities, and she was able to demonstrate that in court. So what's true for one person is not going to be true for the next person because everything depends on facts and circumstances. So all the rest of the show, I'll be talking about how it depends, but I'll tell you what it depends on. So with that, what do we have going on this week, Serena?
So we had a question come in. Someone wants to know what triggers an IRS audit and how can I avoid
Yeah, there's a couple things.
one? It is.
Uh, so the number one trigger for an audit is a mismatch. So if you do not report things accurately that other people have reported, that's number one. So all the third-party forms like your 1099s, your W-2s, your 1098s, your 1095s, everything that some other company sends something into the IRS and then you send something into the IRS and those two things don't match, that's number one. But then there are more subtle things. So the most audited thing are self-employment that gets credits for the earned income credit. So self-employment means you're filing a Schedule C. This is a small business that is not incorporated and not formalized into its own tax return. So you have a double whammy in that, maybe you're not reporting all your income because a lot of people who file Schedule Cs don't. Maybe you're overrepresenting your expenses because a lot of people who file Schedule Cs do. Maybe you're filing in such a way that it enables you to gain tax credits for the kids under the earned income credit. So this is number one, or I guess number two for the IRS because it's the largest single thing for them, and it is easy to bully people in this group because many years ago, that's probably like 10 years ago now, the then commissioner of the IRS was hauled before Congress, and Congress was asking him, why are you auditing poor people so much? And this is people who are getting the earned income credit for their kids because you have to be making effectively less than 30 grand in order to get these credits. So why are you auditing poor people so much? And the commissioner says, like, well, a couple of reasons. One, auditing rich people is a lot harder because they have tax professionals, they have lawyers, they have all these people on their team, and they have much more sophisticated strategies, which requires us to have much more experienced revenue agents. And those people are actually harder to keep on the payroll because they can go off into private sector and make more money. So that's number one. Number two was that it was just easy because when the IRS sends a letter to somebody making $22,000 and says, "Hey, you owe us money," they just kind of roll over and cave, and they don't fight back because they don't have tax professionals on their side. They're not paying thousands of dollars a year to get their taxes done. They're just going to um, some shop that charges them $100 or whatever. So that's number two. So having self-employment income that is not third-party verified, didn't come from a 1099, didn't come from a W-2 or anything, just say, hey, I made 15 grand and I happen to have two kids, and therefore I'm entitled to all this money from the government. In fact, there was another story out this week of there was apparently somebody who worked for a Jackson Hewitt franchise, I think it was, might have been Liberty Tax, or somebody who works for one of these franchises was out in front of the Roosevelt Hotel in New York, where not all, but a lot of migrants are being housed by the state of New York. And they were handing out, I don't know, leaflets or something about how they can get $14,000 in tax refunds because basically the argument is that they would create these fake Schedule C businesses and then claim credits for the kids, and then you get a tax refund. So, there's been a big uproar online about this, and we'll see if anybody gets prosecuted or not, but probably not. So that's number two. Number three, with audit triggers is things that are just out of line. So I had one client, was a married couple. They came in. This is, I don't know, 2013 or something. So they come in, and they're a new client, and they bring their old tax returns. And they brought this letter. And the letter said, "We are charging you a frivolous tax return penalty," which I had never seen before. It was a flat $5,000 penalty. And they said, "Yeah, we never got a refund last year." And I said, "Okay, well, let's look at it." So I'm looking through the letter, and the letter says you have filed a tax return that is false on its face, meaning that we don't even have to look into it. We're just assuming that you're lying, and we're going to charge you $5,000. And so I was like, okay. And so I looked at their previous tax return, and husband was an engineer, wife was a teacher, I think it was. And so I'm looking through the tax return. It looks fine. I don't see anything that would cause that kind of letter. And so I'm like, this tax return that you're giving me does not match this letter. So what I told them to do is I told them to go get their transcripts from the IRS to see what was actually filed. And it's a good thing I did. So they come back like a month later because, it takes time. And the tax return that was actually filed was the one they gave me previously, but with one addition. The one addition was the federal fuel tax credit. So this is a credit for every time you buy a gallon of gasoline, there are taxes built into that gallon of gasoline for that price. So like I just filled up the other day, Georgia here is fairly cheap. I paid $3.07 a gallon, and there's, I don't know, 20 cents of tax inside that $3.07. And so if you use it for certain purposes like off-road construction or charitable things, then you can get those taxes back as a refund. And on the tax return, all you do is you put in a number. It says, yeah, I used 4,700 gallons last year. And it calculates the number and says, okay, you get a refund of whatever, $3,000. And so what we found out, well, it took a little bit of investigating. What ended up we figured out happened was they went to a tax preparer. They were given the version they gave me. And then after they left, the tax preparer changed the tax return to add this on and then filed that in order to gin up the refund and so he could get some more money. So we went through all that and said, okay, well, that's the reason. And so what I advised them to do is that they should go to the Taxpayer Advocate Service. The Taxpayer Advocate Service is the advocate service for taxpayers against the IRS. So it's like their own internal affairs kind of thing. And their job is to help taxpayers when they can't get resolution from the IRS. And they ended up ignoring my advice because it turns out the taxpayer was the husband's brother. And so the brother ended up costing them whatever the refund was, plus $5,000. And they decided to not pursue it because, family stuff. So, that's another one. If you find yourself with federal fuel tax credits, that's a huge audit risk. Um, and other things like that that are just kind of out of balance for your particular situation. It's hard to give a general rule there because what's out of balance for you meant it's going to depend on your situation. But you just want to be mindful of that. So in I was just working on a tax return where the taxpayer is getting a big refund, but because he didn't take any of the Obamacare credits up front. So he paid the full way, and he's entitled to credits though, because they should have kicked in like 80% of whatever he paid. And so, he's getting a nice big tax refund. And last year the IRS gave him trouble about it. And, but he's 100% entitled to this. So just because it's a big number doesn't necessarily mean that it's a problem, but it does. The larger the number is, the more friction there can be. Sometimes they have to take their time. Uh, one of the stories from my old mentor was that he was working for a company and they had double paid their Michigan state tax payments. So they paid estimates, and then when they filed their tax return, they didn't put the estimates in there, so they paid again. And they ended up they should have gotten a refund of like $300,000 or something like that. It was a big corporation, and the and so they sent in this request to the state and said, "Hey, you owe us money." And a month goes by, 2 months go by, 3 months go by. They end up calling the state and say, "Hey, where's our money?" And it turns out that in Michigan, if a check was more than $250,000, it had to be signed by the lieutenant governor, like personally. And so, it's just sitting on his desk, and he hadn't gotten to it, and it took him another couple months to get to it. So, those kind of things can come up when it comes to larger numbers. So, but yeah, I'd say as far as like 1, 2, and 3, that's probably the number 1, 2, and 3 triggers for audits. Now, there's always random pick your name out of a hat. That happens. And also each year, it seems like the IRS picks a pet issue. Now we never know what that issue is until the audit cycle hits in about 2 or 3 years after the fact. So like some years they'll look at charitable contributions. It's like, oh, you gave $5,000 to charity. Let's see your proof. And other years it's been unreimbursed employee expenses, which is no longer a thing since 2017. But that was one. Schedule Cs are always high on the list. So it just kind of varies, and you have a certain probability of just getting randomly selected for these kind of things. So you might do nothing wrong and still get an audit, but you definitely want to make sure that things are as buttoned up as they can be on your side.
So Neil, really quick, so there is an audit risk, right? Like a percentage, like what is it? What's the percentage nowadays on the audit risk on the 1040 side?
Well, for this year, it's hard to say, but in the past, it's been about 0.5%. So there's like a 1 out of 200 chance that your name gets picked out of a hat. But the more money you make, also the higher your audit risk goes. So like if you're making over like 5 million, you basically have like a 1 in 20 chance of getting audited just because. But yeah, that's might be changing with all the layoffs and everything. So we'll have to see how that goes going forward.
Okay. All righty, Fatma.
All right, Ross. So we have a question from one of our clients, and your question is, what are the rules for deducting meals and entertainment in 2025?
Okay, so entertainment, not deductible at all. That was one of the changes from the Tax Cut and Jobs Act, and it used to be 50%, and now it's 0. For meals, basically, there needs to be, well, one, it's a 50% deduction, not a whole deduction, because you got to eat. So, do you have to eat that fancy dinner? Probably not. So you only get half credit. So there has to be a business purpose to it, in that you're talking with a client, with a prospect, or management, or whatever, and it's got to be with somebody. It can't just be by yourself. And that's part of that business purpose. And as long as you do that, and you obviously, like everything, the thing that people get caught on is the substantiation. So like if I just have a receipt from Waffle House, like I just made with ChatGPT, then technically that's not sufficient. Really, I should have a log of who I was talking with or who I was eating with and what we were discussing, why it was a business meeting, and that's all in to substantiate your claim on your tax return. I will tell you, very few people actually do that. You should. But one thing that is helping now in our age of technology is calendars. So, I use Google Calendar for everything. If it's not on my Google Calendar, I'm not being there. So, and that's true for Zoom meetings. It's true for in-person meetings. It's true for everything. And so, that in itself can serve as a log, and you just put in, whoever it is you're talking to and what it is that you're doing. So, I have a breakfast meeting once a week with a business networking group, and that's 100% a business meeting. I 100% take that meal deduction. In fact, I make sure to use my business credit card rather than my personal card when I buy the food, and that's substantiated in several ways on my calendar, and then in my networking group, there's a website and it has an archive of all the meetings and everything. So, so all that kind of stuff. All that kind of stuff works. But yeah, so where people get into trouble with meals is when it's really high. So I've seen people like dine out at the Ritz-Carlton every night for a year, and they say it's all business expense. It's like, well, does that pass the SIF test? I don't know. It's it's up to you how aggressive you want to be with that. But if the number is compared to your revenue, if the number is reasonable, then I wouldn't worry too much about it.
Alrighty, so we have another question that just came in, Neil. It's a tax planning question, and someone wants to know, how can I plan for taxes if I expect a big capital gain next year?
Yeah. So here's the thing. I think I know who that was from. So if you have large capital gains that are unusual, so we've got a lot of clients who are retired, and they're in these mutual funds, and there's capital gains every year because inside the mutual funds they're selling their holdings, from time to time, and so there's always going to be a pass-through capital gain event. But it's usually fairly consistent within within a few $1,000s, right? But if there's something that's outsized, then you have to factor in the fact that, yeah, I mean, there's taxes with capital gains. Now, I will tell you, long-term capital gains rates are the biggest scam going in the tax world, and I'll explain why. So long-term capital gains rates are for things that you have owned for at least 1 year, and for that, you basically get half off on your taxes. So if you buy something for $50,000, hold it for over a year, sell it for $100,000, now I have got a $50,000 gain. So my long-term capital gains rate is going to depend on my total income for the year. It's either going to be 0%, and this is federal, 0%, 15%, or 20%. And if your overall income is high enough, you're also going to be hit with an Obamacare tax, the net investment income tax of 3.8%. So realistically, it's going to be 0, 15, 20, or 24% federally. And then each state handles capital gains in different ways. Sometimes it's just the regular rate. Sometimes there's a preferential rate, like Massachusetts has a preferential rate. But most of the time, it's just going to be whatever your state tax rate is going to be on that as well. So figure 5%. Okay. So just know that there are capital gains taxes. So that's number one. Just know that they exist. And planning for it, really, it comes down to like what else is going on, what else can we do, and then just being proactive about it. So the thing with capital gains is that they're not surprises typically. You got a big chunk of money somewhere, so recognize that, plan for it, know that there's going to be taxes associated with it.
Right.
So yeah, and if the number is really big, then there are exotic strategies, and I talked about the exotics before, but there are exotic strategies for dealing with that. But those need to be like well over 6 figures, usually like 500,000 and up, that kind of thing. So if you're in that camp, give us a call and we can talk about some of those options. But by and large, just know that the taxes exist, set aside money, or make an estimated payment for that potential liability. Now, the reason capital gains rates are the biggest scam going is because they are not inflation adjusted. So if you held a stock, like I've got a lot of people who have held stock for 30 years, and it's like, yeah, the cost basis is like almost nothing compared to the price today, and so the entire thing gets taxed. Now, yes, it's a discounted tax rate, but it's still taxed. But when you inflation adjust that purchase up to over the 30 years, the capital gain might actually be nothing, and it's just that your money has been eroded due to inflation. So by and large, the longer the term of the capital gain, the worse the real tax rate is. And when I say real, I mean adjusted for inflation. And you can go to the Bureau of Labor Statistics, so BLS.gov. They have an inflation calculator according to official government statistics, which may or may not be, conservative or not. And you can say, okay, well, if this thing cost me $30,000 in 1990, what's $30,000 worth today? In fact, we can do this. Wasn't planning on doing this, but let's give it a shot. Let's see, BLS inflation calculator. What's that website? Okay, bls.gov/data/inflation calculator. All right, so let's share this screen. I'll go to here. Okay, so let's say S&P 500 chart. Sure, let's go to Yahoo Finance. And let's go to, I don't know, how about 1995, way back here. So back in 1995, the S&P 500 was $453, okay? So let's say 453, January of 95. And you sold it today, right? And today it's 5,600. So basically a 10x. But inflation adjusted, it's 961. So, it's really a 5x in real terms, according to government statistics. So you're paying tax on that doubling that you never got in real terms. And so if I'm getting taxed at half rate, but I am missing out on a 2x rate of return due to inflation, then those cancel out. And effectively, I'm paying regular tax rates in real terms on the money that I made. So that is, in my opinion, that's the biggest scam in tax right now. Now, during Trump 1.0, there was a proposal to inflation adjust cost basis in capital gains, but that was never passed, unfortunately. But maybe, I kind of doubt it, but maybe that will get done this time around.
Alrighty. So for my next question, so should I form a holding company to manage my multiple businesses?
Probably. Whether it's so in the end, a holding company doesn't accomplish anything tax-wise because everything's going to be flow through. And so it all comes out the same. What it does do, it allows for better organization and allows for better use of resources. Because if you have multiple businesses, a big problem that people get into is it's like, well, I've got this program that I pay for over here, so I'm going to let this company over there use it. Well, it's like, well, is that really right? Really what you should do is company A should be charging company B for the use of company A's resources. And yeah, it's a wash tax-wise because the income on one side balances out with the expense on the other. But in order to have accurate books that represent reality, that's really what you should be doing. So when it comes to having a holding company, then you can do those things like parent to child in terms of the entity relationship rather than brother to sister. So it can make for much cleaner books. And this happens a lot with staff. So if you've got somebody who works in company A who does, I don't know, bookkeeping, let's say, and you also have them do bookkeeping for company B, but you don't charge company B for it, then what are you doing? So you're not accurately reflecting the reality of the situation in order to get things done. Again, on a tax basis makes no difference, but for organization and for clean books, yeah, generally, I think it's a good idea. It's also it becomes more important when you have businesses in your portfolio that are joint ventures with others. So if everything's yours 100%, then it kind of doesn't matter. But if you've got like three businesses that you own and then 100%, and then you own 50% of another business that you have a partner on, then it becomes critical to have that organizing structure so that the one doesn't throw everything else out of whack. And if you want to, we did a webinar, I don't know, year and a half, 2 years ago on partnership setup kind of stuff, which goes into all that. I think that's on the Explorer side. I'm not actually sure, but yeah, that's the organizational principle remains true, that you definitely need a home base for everything to come into that you can do all your adjustments on. And that way just keeps everything cleaner. So in general, I recommend it. It does increase, complexity of things and all that kind of stuff, but it's worth it in my opinion.
Yep. So yeah, you guys heard Neil. Go get that started. It's a better organization, right, Neil?
Yep. Most of the time.
Most of the time. Right. So we have another question that came in. It's a tax strategy question, Neil. Someone wants to know, how can I use charitable remainder trust to reduce capital gains taxes?
CRTs. Okay. So charitable remainder trusts are very complicated. Basically, what you're doing is you're giving up possession of something, like a house or a stream of income or something. You're putting it into this trust, and it is going to be used for the benefit of somebody. Oftentimes it's a spouse, for their lifetime. And then after their lifetime ends, they pass away, then it goes to the charity as like whatever the remainder is. That's where the name comes from. And so it gets very complicated because it's going to depend on the actuarial value of the assets that are put into the trust, and are and that's going to depend on the life expectancy of the person who's the beneficiary. So if you do it for somebody who is 20 years old, then the charitable remainder of value is going to be very low because the person who's 20 has a long time to live. They're going to use up most of that value. If you do a charitable remainder trust for somebody who's 80, then the charitable value of that is very high, because the person who's 80 doesn't have a long life expectancy at that point, and most of that value is going to go to whatever charity it goes to upon death. So super complicated. The lawyers love them because they charge a lot of money for them, and in general, not my favorite way to do things, just because people don't get quite the benefit that a lot of times they think they do. Now, the thing with trusts in general is that every trust is different. Every lawyer has their own way of doing things, and so the specifics really, really, really matter a lot when it comes to trusts. And so you have to be really aware of what is going on, what the monetary impact is going to be, whether things are revocable or irrevocable. Because if it's revocable, you can take the thing back, then it doesn't count for anything for taxes. If it's irrevocable, that means you're putting it in this special bucket and you can't touch it ever again. So you got to be aware of all these things. And there's been some cases recently about some abusive trust structures that have been disallowed by the courts. So there was one going around a few years ago of like, they created a spendthrift provision. Basically, this trust is set up for the benefit of Joe. Joe can't manage his own money because he's a wastrel, and so the trust is going to manage money and pay stuff for Joe, so that he can survive. Right? That's a spendthrift provision, and there are some special rules that go along with that. Basically, the trust doesn't pay any taxes at all, was the pitch. And a lot of these were found to be overly aggressive and got thrown out. And the $100,000 that the lawyers were paid went up in smoke to set these things up. And then the owner of all these things, had to pay fines and penalties and everything. So be very, very careful with those kind of trusts. Now, trusts absolutely have a place. But but it's usually, at end of life rather than trying to live the next 50 years out of a trust that is never going to pay taxes. So that kind of pitch, be very careful about. Just because, again, it's a thing that has been abused. It's a perfectly legal thing. People abuse it, and it increases, audit scrutiny. So that's one of those. But yeah, if grandma needs a place to live, a charitable remainder trust might be appropriate.
Right, well, thank you for that. And so for my next question, it's how do I handle taxes if I work remotely from a different state?
It depends. So it depends on the state. So
Definitely.
yeah, like New York is terrible about this. Basically, New York determines that all income from New York sources, regardless of where you are, is New York income, and then you have to apply to them as a non-resident to try to get as much of that back as you can. So that's item number one. California is aggressive. On California, you have to do a Schedule 540 NR, which is basically a table that it lists the total income from the different sources, like wages and interest, dividends, and whatever. And then it has a column for like what you would have paid if you were a California resident, and then another column for what you would have paid if you were not a California resident, and you end up with somewhere in the middle a lot of times, because it depends on, like, did you ever go to California for a meeting or something, and then you spent one day in state, and then that touches the waters, which is one of their doctrines. So there's a whole thing. Now, in most cases, aside from those aggressive states, in most cases, if your business is located, whether you're an employee or whatever, if you're, I'm in Georgia, so let's say you're located in Georgia, you're doing work for a company in Indiana. In most cases, you're going to recognize that income in Georgia, and then the people in Indiana who are paying you are going to deduct that in Indiana, and that's okay. But there are specific circumstances where you got to be a lot more thorough than that, and it depends on the setup, whether you're a contractor or whether you're an employee, and all those kinds of things. So that's a long way of saying it depends, but most of the time you're going to recognize it in your home state, and even if you have to pay to a different state, every state in the country, at least that has income taxes, has an other state credit, meaning that let's say I have income that would cause me to owe $5,000 to the state of Georgia, and I already paid $3,000 to Alabama. Well, Georgia's going to give me credit for that $3,000, and they're only going to charge me $2,000 on the balance. Now, that only works if your home state is higher than the other state where you might have to recognize income. And sometimes that works, sometimes it doesn't.
So that is, like you said, it depends question.
It depends.
Understood. So it looks like we have another question that came in. Someone wants to know, how does the IRS treats the hobby income versus the business income?
Yeah, so hobbies are like the worst of both worlds. If you have a hobby and you make money, you pay taxes. If you have a hobby and you lose money, you don't get any deductions. So that's why you want to stay away from hobbies that have any kind of money-making component to it, at least. And how do you define whether it's a hobby or not? Well, it's facts and circumstances. So it comes down to, like, are you in the pursuit of money in this thing, or are you in the pursuit of enjoyment? And people are often very worried about the hobby loss rule when it comes to businesses, because I've heard all these horror stories, and the horror stories do happen. They happen mostly when there's like fun stuff involved. So, like, there are certain regions of the country or cities where people just have a lot of unusual stuff. So, like, there are a couple towns in Florida where it's like everybody there has horses. It's just something that they do. So like Ocala, and what's the one down by Miami? Is it Hialeah? No, it's not Hialeah. Anyway, there's some city near Miami where everybody has Weston. That's what I'm thinking. Weston, Florida, also has a bunch of horses. And so if somebody has a horse farm in one of those areas, horse farm, the question becomes like, well, do you really, or are you engaging in a hobby and trying to get tax write-offs through it? And the IRS has a habit of questioning these things in those areas where these things are common. So if there's a whole lot of horse stuff around, if you're at a place where everybody has a boat and everybody has some kind of boating business, if you are farms, like a very small farm, those can sometimes get investigated. And the hobby laws rule says that in a 5-year period, if you lose money in two or fewer of those 5 years, then the burden of proof is on the IRS, meaning they have to prove that you are in this not for the money, you are in this as a hobby. Once you go to 3 years or more out of those 5-year windows that you've lost money, then the burden of proof shifts to the taxpayer. And so the IRS could come in and they could say, hey, prove to us that you're a business and you are not a hobby. And if you don't do it to their satisfaction, then they're going to disallow all those deductions over that 5-year period, and they're going to charge you tax and then interest and whatever on the on what you should have paid back then. So that's what people get worried about. It's actually fairly rare for that to happen, but it does happen. So you just want to make sure that you are doing the things that a business does. So how do you prove that you're in this as a business rather than a hobby? It's like, well, number one, you keep records. So you do your bookkeeping. Number two, you have separate accounts for business stuff versus personal stuff. Number three, you do business type stuff. You try to sell things. You go to vendors. You advertise. All those kinds of things that every business does in order to keep their lights on. Those are the things you should be doing in order to support the fact that you are a business and not a hobby. So that's where all that comes in. And yeah, so as long as you do the things where you are demonstrating that you have a business, it's nothing to really worry about. It's the people who kind of say, well, I did this thing, I think, I don't have any records. I didn't keep track of anything. No, I didn't make any money. I had zero. So that's another one, actually. Zero sales is a problem, because are you in business if you made no sales? Maybe. It does happen, but it's rare. So my favorite example was near my house, there's a shopping center where I go grocery store. And in the corner of the shopping center, there was this particular bay. And there's been I don't know how many businesses have come in and out of that particular location, because it's just not a great location. And one time, I go into the grocery store, and I see that it was one of those places where how with frozen yogurt you can pour your own yogurt and then you take it to the counter, they weigh it and they charge you based on that. So
Yes.
it was that, but instead of frozen yogurt, it was popcorn. And then all different flavors of popcorn. And so they had the nice shiny machines, and I never saw a single person in there. And 3 months later, they were gone. So did they make zero sales? Maybe, I don't know. But I know they didn't make a lot. And whoever, put all the money into the machines and the build out and everything, they lost all of that. So, there are circumstances where you literally make no money and you have expenses, but it is rare. And it does not go on forever and ever, because by definition, if you're losing money constantly, you will run out, eventually, unless you have shareholders or something that are backing you, which is a whole different story. But on the small business scale, that just doesn't happen because people can't live like that. So there's a sniff test you have to pass for yourself in order to make sure that that things are on the up and up, and it is a business and not a hobby. So with that, I think that'll be the last question, unless there's one that's real quick. Do either one of you have a quick one?
Rama?
Let's see, boss. Here. So for the last question, boss, how do I balance taking a salary versus dividends from my S corp?
Ooh, that's not a short question.
That's not that one's not short. Let's see.
We'll have to save that one for next week, because that's a 30-minute question.
Okay, I have a quick one. Can I lose my tax refund if I owe back taxes?
Yes. So if you owe back taxes, could be to the feds, could be to a state, it could be student loans, it could be child support. There's a bunch of reasons. They call that an offset. meaning that they will take the money out of your refund first, and then they will send you the remainder, if any. The exception to that is if you are on a payment plan and you are current. So if you're on a payment plan but you're late, it all goes out the window. But if you're current, they will allow you to take your current year refund and just stay on your plan as is. So that's where we are for that. So if you have an outstanding balance and you're not on the payment plan, they're going to take your money. It's just how it is. All right. With that, let's go back to it depends. And what are your next steps? Well, if you're not already, join the Explorers. It's free. You'll get access to shows like this. You'll get a lot of our tools. So some of our stuff is free to Explorers, and some stuff is premium. But most of the stuff, I would say the most important things are free. If you want to upgrade, there are perks for that. We get weekly calls that are more one-on-one and everything. But by and large, just go to taxsherpa.com/explorer, or you can scan the QR code there, and that'll take you there. You sign up, and you'll get a whole slew of emails. I think there's like 3 emails that come out right away, and then you'll get access to the Explorers platform, where you can get things like, my favorite thing is the quick and dirty bookkeeping system, and that's where small business people can do their bookkeeping in 5 minutes a month. And as long as their situation is simple. So if you have a complicated situation, it's not going to work. But if it's simple, just cash in, cash out, one account, it'll do you really, really well. And with that, that brings us to the end. We do this every week, Tuesdays, 6 p.m. Eastern. And we'll see you next time.
Right.
All right.
All right. I'll catch you guys later.
Okay.
Okay, bye.